Hi, I'm Rex Evans with Derivative Logic. After yesterday's pivotal decision by the Federal Reserve, it is my pleasure to introduce a discussion between our economic consultant, John Rothfield, and Dr. Mickey Levy, currently visiting fellow at the Hoover Institution at Stanford University and a long-standing member of the Shadow Open Market Committee. John and I have known Mickey since the early 1990s during his 25-year tenure as the chief economist for Bank of America, where through his economic expertise, policy context, and forecasting ability, the bank was ably steered through a long period of growth and change. With his expertise across banking, academia, past cycles, and policy, and his reach into the key decision makers, there is nobody more qualified to have a view on what now. Thank you, Mickey, for joining. John, now it's your turn.
Well, Mickey, I definitely echo Rex's comments at the start of this presentation, because we have worked together for a long time, and you have all of these contacts and you have all of this perspective. And there's a lot of change going on at the Fed and in the economy, and I think we're very honored to have you on today. I'd just like to start out by quickly describing some of the things that happened at the Fed yesterday. One was that the Fed did a 25 basis point cut. And despite a modest tweak higher in the outlook for GDP and inflation in the median projections, the so-called dots for the end of each year went down about 25 basis points in each year. So there seems to be a little bit of a disconnect between changes in the forecast and the projected Fed funds rate, although that is really not unusual. The other thing that came out of it was there was only one dissent. So Steve Mirren dissented for a 50 basis point cut, and his own dot, we think, had a massive 150 basis points of cuts this year to take the Fed funds rate below 2%, so below 3%. So we kind of have an idea of what Steve Mirren, if he ever gets more control over the Fed or one of somebody similar, would do to the Fed funds rate. But there is also a cohort, one non-voter didn't have any cuts at all this year, and 6 or 7 out of 19 don't anticipate any further cuts this year. So there's quite a bifurcation of views, despite the kind of the collegiate only one dissent this time around. After today's decision, the OIS market is still at a cumulative minus 150 basis points for the year ahead, which is more than is priced in the Fed dot, which is 100 basis points. So that disconnect is also not unusual. So one of the more interesting things I think about the decision was that after the initial announcement, the risk markets improved and yields fell. And then by the end of the day, which is not unusual, particularly after the Powell press conference, things went back the other way. And we finished the day pretty much unchanged. We had a slightly higher 10 and 30-year bond yield, so a little bit of a steepening of the yield curve. But overall, if one was to grade the decision on its impact on the markets, which was fairly muted, and also the fact that there was only one dissent, one would potentially give it an A grade. But I wanted to get your perspective on how you think the day went, particularly the dichotomy potentially between the decision itself and Jay Powell's press conference.
Well, John, I think you did a great job of summarizing what the Fed did. But let me add up what happened and make a simple observation. The Fed recently, at its Jackson Hole symposium, came out with its new strategic plan, where it removed all the asymmetries. It's biased toward prioritizing employment, toward favoring higher inflation. It went back to a more neutral interpretation of its dual mandate that it had in its original strategic plan in 2012. Now, in that context, let's consider what the Fed actually did yesterday. It's forecasting inflation remaining well above its 2% target. And as you pointed out, they've actually moved up their forecast of inflation for 2026. At the same time, in the policy statement, it expressed concerns about weakness in labor markets. It tweaked up its forecasts of real GDP, and then it voted to lower rates. So basically, when you add things up, the Fed is basically saying, we still prioritize employment, and we're willing to tolerate inflation persisting well above our 2% inflation target. I find that quite striking. That, remember, beginning in 2021, inflation went above 2%, and it's been well above 2%. And this, by 2020, end of 2026, it'll be the sixth year in a row. Yet the Fed's willing to tolerate that. It shows this asymmetry. And I find that the biggest walkaway, from the report, in addition to all of the speculation about how Steve Mirren being a new member while still being affiliated with the Council of Economic Advisors and the issues of Fed independence. But the basic issue is the Fed is okay with inflation remaining well above its target. And it's still
how do you respond to the defense probably in the press conference that this was a risk management cut? Because we know the labor market's weakening. He mentioned a lot between job finding and job hiring are both kind of racing towards zero. So if you get a cut in hiring, then it could lead to a decline in the labor market. So this is a risk management cut from a situation where, and these are very ephemeral kind of concepts, from a situation where we were perhaps mildly restrictive.
Well, okay, you toss a lot of things in there. Powell did perceive of it as a risk management cut, but the risk management is all about their expectation that labor markets are going to weaken, not about inflation going up, or they're very complacent about it staying high, and that's a clear signal. Now, one other point, John, you correctly point out that the Fed, particularly Jay Powell, have characterized current monetary policy as restrictive. Their perspective on monetary policy being restrictive is based on their observation that, hey, the federal funds rate in inflation-adjusted terms is much higher than its long-run estimate of the real funds rate. That is, the funds rate effectively now 4.1. It was 4.3. PCE inflation is 2.6 or 2.8. Excluding food and energy, and so you have an inflation-adjusted funds rate 1 point, over 1.5. So the Fed says, oh, that must mean monetary policy is restrictive. But let me toss a wrinkle in that. What if instead of the quote unquote neutral funds rate that would be consistent with sustained economic growth along their potential path and 2% inflation, what if instead of the real funds rate, neutral rate being 1%, what if it's actually 2%? And of course, I'm saying this because the neutral rate is an unobservable concept. So the Fed, so we all acknowledge that the U.S. economy has been much more resilient than people had thought. And even now, when you see employment growth slowing a lot, the Fed has explicitly acknowledged that the weakness in employment reflects the negative impact of immigration clampdowns on the supply and demand for labor. But real GDP is still humming along. If you look at the Federal Reserve Bank of New York's nowcast, it's over 2% for Q3. That's above the Fed's estimate of long-run potential growth. So they still have this tendency to lower rates, and even today, bond yields have edged up a bit, and the Fed's in a dicey situation. We'll see in the longer run whether they're right or wrong.
Maybe I should throw in a curveball to meet yours as well, which is around the issue of financial conditions, because it's not part of the Fed's mandate, but we had the tech bubble, and we got to a point where the Fed started to produce a half-yearly financial stability report. The last one was in April before the blow up from tariffs and things like that. We have another one in October, November. Basically financial conditions. Well, we've never had as high a ratio between stock valuations and GDP. The old Buffett indicator is well above the levels that he would be comfortable with. Not that that's a kind of economically justifiable level, but it's very high. The other thing I've been looking at is gold. The real gold price is very, very high. And I look at it also in relation to the real economy, which is, say, copper, coal, and iron ore. It's not just a commodity thing, it's a gold thing, it's a monetary phenomenon. So I've also been quoting recently James Tobin's paper economy, the idea that we have this disconnect between the real economy where things are muddling along versus a paper economy, which is very inflated. And, the negative implications of that for productivity and things like that. So how do you feel about what the asset markets are telling us about the state of monetary policy? Or is that a side issue?
It's not a side issue. First, I want to completely applaud what you just said and articulated how financial conditions seem loose rather than restrictive. And in fact, the Federal Reserve Bank of Chicago's Financial Conditions Index has been either persistently loose or kind of okay, and the Fed interprets it as restrictive. So it's kind of a head scratcher. And as to the paper economy that Tobin used to talk about, consider it in direct response to COVID, M2, a broad measure of money, increased 40%, and that was partly a fiscal response. The government was just too expansive in providing income support, and a lot of it was saved. And showed up in M2, but that liquidity is still floating around out there.
Sure.
Okay.
Reserves are well above what, say, Chris Waller regards as ample.
Yeah, it's still floating around. So let me. I'm not a stock market strategist, but let me make the following observation. The stock market high valuations reflect a couple things. First, the resilience of the economy. It's still growing. And that means corporate profits are growing. And by the way, even though productivity measures show so-so increases, there's an absolute disconnect, and there always has been, between corporate profits and productivity. In addition, the high-flying high-tech companies, the pace of technological innovations is just in a wide array of industries is just staggering, and their implementation into commerce and society are very rapid and equally staggering. And so the low interest rates and low bond yields increases the discounted present value of the future stream of expected earnings, and that pushes up valuations. I'm not saying it's going to last forever, but I can understand why the stock market has higher valuations than in the past.
Right, and these are firms that are domiciled in the US, but so much of their activity is international. So you can kind of look at the total global stance of monetary policy.
But let me pick up on what you just said, John. So if you take these U.S. based high tech companies, where all the research and development is done here, and even if things are produced overseas, so that it doesn't show up in GDP, the profits are repatriated in dollars.
Mm-hmm.
And so that's one of the reasons why corporate profits increase much more rapidly during an economic expansion than GDP.
Yes. Profits to sales are very high, gross value added are very high still. And then the other thing I would inject there is that there's this feedback loop between asset prices and the real economy, because we have an imbalanced economy that's being led by high income, high wealth individuals, and we have a business investment that's very much focused on things like computers and data centers, and so the high stock market valuations are feeding through back into the economy, which means that you can eventually potentially move from a virtual to a vicious cycle. But your bottom line is that you're not really worried about these valuations, and that they're signaling that the monetary policy, if anything, is too easy.
I mean, that's a tough call. I mean, let me make two observations about the stock market that are kind of in conflict. One is, I won't say overvalued, but valuations are very high. But at the same time, there's momentum, and the momentum has been, pretty persistent. Will we eventually have a correction? Of course we will. Have some of the high-tech, high capitalization companies have their valuations, are they based on overly exuberant expectations of profits? We'll find out. We will find out. But the fundamentals of the U.S. economy are quite interesting. Right now, if you look at the economy, business inventories are in okay shape. Household balance sheets are also in okay shape. Labor to output ratios are in okay shape. That is meaning businesses haven't hired too much. So even if you have a slowdown in consumption and aggregate demand, businesses aren't going to need to clean house as they have sometime in the past.
Really good point.
If we do get a slump in consumption, let's say if employment growth continues to grind down to no change and maybe even dips a little bit, and that leads to a weakness in consumption, even if there is a downturn in GDP, put a small R on it, not a capital R. Okay.
Which so just finishing up on the issue of the kind of the outlook for short rates in say a discrete 12-month time frame. We had a slow first half of the year. It was a transition year between Biden-Harris into Trump-Vance policies, and a lot of uncertainty, etc. So we had slow growth, about half the rate of growth that we had the prior couple of years of raw GDP growth. But then there are some employment's arguably a lagging indicator, but we have potentially some green shoots. You mentioned the New York Fed at over 2%. I also look at the Atlanta Fed's GDP now, which is 3.25% for the quarter. And so and even in some of the Beige Book or the regional Fed surveys, there are some potential green shoots. There was the Philly Fed survey out this morning, which was quite a bit stronger. So how would you handicap the three ways the economy could go from here. And we always, when we work for banks, had to think about this, and you think about it every day as well, is muddle through versus recession risk versus some kind of catalyst that accelerates the growth rate in the way that the administration's imagining.
John, great question. And I'll give you, on average, in the intermediate term over the next couple of years, somewhere in between a muddle through and a strong rebound.
Okay.
But yours is a very good question. I am very, very impressed by, once again, the pace of technological advances and their use, their implementation in commerce and society. I do think they're for real. They're already generating tremendous revenues and profits, and I think they will continue to spread. A second point I would emphasize that you alluded to is what economists call the wealth effect. Okay, if you look at disposable income in the United States, it's somewhere between 20 and 25 trillion a year. It's an income flow variable. If you look at the stock of household net worth, stocks, bonds, real estate, private investments, net of all debt, it's $175 trillion. Wait, that's almost 8 times disposable income. It isn't all owned by Bill Gates and Jeff Bezos. It is unevenly divided, but there's a staggering number of households that have a significant amount of wealth. By the way, of that 175 trillion, almost half of it is held by people who are over 70. And it's trickling into the economy in big ways.
Mm-hmm.
It's flowing into the economy every which way, increasing the propensity to spend out of disposable income. And this is one of the factors that is driving continued healthy growth in consumption. And I wouldn't understate that. And in fact, I'm doing some research now. And what's interesting, John, is the huge decline in the stock market and housing during the great financial crisis was a drag on consumption and the economy and inflation in the 5 years after the GFC. And now it's a big positive, and we shouldn't lose track of that.
Yeah, certainly the housing side is a little bit more wobbly, but certainly the financial asset side is much stronger.
Well, wait a second.
The equity in homes is extremely high.
But wait a second. Yes, and if you look at the Case-Shiller Home Price Index, it's up well over 50% above its pre-pandemic level in December 2019. And empirical work shows that people think of the increase in the value of their house as kind of more permanent than even a persistent increase in the value of their stock portfolio. And this leads once again to increased propensity to spend. And this along with all of the tremendous increase in business investment in building out the infrastructure for AI, those are real forces driving the economy. But we haven't talked about the downside, and I find it just an absolute head scratcher that the Trump administration could continue to push tariffs, which have no positives at all, and it's only a question of how big the negative is, and then the clampdown on immigration. I definitely think it's reducing labor supply and keeping a lot of businesses on the sideline. So it's shifting in both supply and demand for labor. And this,
Yeah, the 4 trillion, we can talk about, very briefly at the end toward the end about the Congressional Budget Office projections of 4 trillion in tariffs revenue offsetting the one big beautiful budget bill, etc. But yes, so I think what I'm hearing from you, and you've talked before about the fact that shelter inflation is going to continue to fall further, but if we're in a situation where you're erring toward a muddle through or an optimistic view of the economy, and the Fed by its own admission isn't going to get back to 2% inflation in a couple of years, then the market pricing in 150 basis points of cumulative easing by the end of next year seems to be too much.
well, John, okay, so 150 basis points. Okay, so the current funds rate as of yesterday afternoon is the target is 4 to 4.25, which and the effective funds rate is 4.1. You take 150 off of that.
Or 125 off that. I was talking.
Okay, 125 off of that. And
you get down to just under around 3%.
Okay, that still leaves you with a mild positive real funds rate, but you still have a lot of liquidity in the market, and recent money numbers have accelerated a bit. So the big question, and you brought it up earlier, you have these conflicting factors. One is the tax cuts, the extension of the 2017 tax cuts. Well, I thought they were excessive, but they do provide a positive because they sustain the lower tax rates, and you have provisions in it like expensing R&D and other positive factors. On the other hand, as you point out, at the current pace of tariffs collections, over a 10-year budget projection, the way the CBO does it, that's going to increase tax receipts, call them, because that's what they are, by almost the same 4 trillion offset as the tax cuts. However, so that you would say, oh, that's neutral, but it's not neutral, because the tariffs bring with them foreign retaliation, tremendous uncertainty. And amid all this, even if the Fed eases, lowers rates, and stimulates aggregate demand, it cannot offset or eliminate all of the negative distortions created by the tariffs, certainly the immigration and the uncertainties.
Well, I'm certainly not an advocate for tariffs.
John, you and I have spoken about this.
The trade deficit has almost nothing to do with foreign practices. It's a savings investment imbalance. But on the immigration question, I think that's an interesting one, because the CBO's latest projections of population basically say that by 2030, the the nativity birth death numbers will be zero. So that any population growth that we have after 2030, roughly, if I'm not mistaken, will come from foreign-born workers. I'm not tapped into the final policy prescription, whether we get more participation out of the existing workforce, young men, things like that, people retiring later, etc. But at some point, we're going to have to address the issue of the declining native-born population.
Oh, I couldn't agree more, John. If let me put it in economic terms, capital and labor are the two foundations for economic growth. Toss into a total factor productivity. There's capital and labor. So you have tariffs, and all the uncertainties undercutting businesses' incentives to invest, or at least you could say the tariffs offset some of the positive incentives that were in the tax cuts. And then what's going on with the clampdown on immigration, we're seeing right now the short run negative effects of that on labor supply. If it persists, then everybody's estimate of longer run sustainable potential growth has to be cut. Because once again, long run growth is determined by labor force growth and productivity and
At CalPERS, we had to
capital.
do a project for our CIO about so-called Japanification. Now, the US is not Japanifying, but a lot of countries are already experiencing the aging of the population and the so-called, dependency ratio, etc. That's an issue that ultimately we're going to have to address, not in the short term, but the long term. Totally agree.
Well, yes, but let me add a wrinkle. Japan doesn't really advertise this now, but over 2% of its workforce are foreigners now. They've eased up on green cards. They encourage foreigners to come in and work, and they create a very healthy environment for it. That's increasing their potential growth.
Yes.
And we're going the other way. And
yeah, we'll see how that plays out.
We'll see how it plays out.
So I want to get on to the second of the elements of talking about here, the more awkward one, which is the Fed's independence. We've had the Fed's structure has been broadly unchanged since the Banking Act of 1935. Same number of board of governors and 12 regional feds, pretty much the same system. And there have on occasion been attacks on the autonomy of the Fed, but just going very quickly through a couple of these, we have Steve Mirren coming to the board while he retains his Council of Economic Advisors position. We have the attempt to remove Lisa Cook from the board for cause. We have some in the market are talking about the normally routine 5-year reappointment of the 12 regional Fed governors coming up in February. That if the president can get a majority on the board, that may even be up for issue. And then, of course, there's this issue of who replaces Jay Powell as Fed chair. So Jay Powell yesterday continues to talk about the collegiate atmosphere. Once you get in the room, people are analytical and they're unbiased. But based on your experience, are there any kind of precedents, or are we overreacting to this possibility? And so, what do you think of all these things?
John, I don't think we're overreacting. Let me just state at the outset, we all benefit from an independent central bank, and it is being threatened now. President Trump is threatening the Fed. It has come under threats before. I would say, I'd say if I had to use another word for describing the Fed, I wouldn't use the word collegial. I would use the term circle the wagons. There are people within the Fed who have different opinions. It is a political place. The 7 governors of the Fed, including the chair, are nominated by the president and confirmed by the Senate. They all vote at every meeting. The president of the Federal Reserve Bank of New York, who also serves as vice chair of the FOMC, votes at every meeting. But the other 11 Federal Reserve Bank presidents have to rotate their voting. They only have 4 spots, and so they have to rotate their votes. Now, I might note that while Steve Mirren got a lot of attention yesterday on what his dots were and how he dissented, the real importance here is not what he did yesterday, but he has written a paper on proposals for major reforms of the Fed. Major. And those include what I consider some good provisions, like decentralizing the power away from Washington, allowing every Federal Reserve Bank president to vote at every meeting. But then some provisions, proposals that I don't like giving the president of the United States carte blanche to fire at will any Federal Reserve governor or bank president. And there are a lot of other provisions in it. And if his tenureship and his current governorship goes through the end of January, if he is renominated and you get a new chair replacing Powell that is also open to major reform, then you could have some real changes, some potential changes. And will they affect the conduct of monetary policy? And not right away. But let's just put it this way, John. The Federal Reserve has made a lot of mistakes. Its policy track record is it's made some good moves, it's made some very poor moves, and it could have done much better. But it doesn't admit its mistakes, and even though it knows its structure needs improvement and its governance needs improvement, it would like to not change anything. And so you could have some real contentious debates within the Fed about its governance and how to remain independent.
And from what you know, would that require a change in the Banking Act to bring in those changes, or would it be something
for some provisions, yes, for others, no. Yeah, it would require some big changes. But here you have an independent policy body. It has its own budget. It's the only government agency that doesn't have to go through the budget appropriation process. It calls its own shots, and it presumes that it will remain independent regardless of what it does. It doesn't have sufficient oversight. The Fed was created by Congress, and Congress is supposed to supervise the Fed. But if you look at the semi-annual hearings and the ad hoc hearings conducted by the Senate Banking Committee and the House Financial Services Committee, the two committees that are charged with supervising the Fed, they don't really supervise. It's more grandstanding. And
this other issue of the 2023 situation with Silicon Valley Bank, First Republic, etc. So some of the macro-prudential stuff, is that mission creep by the Fed, or?
Okay, you're bringing out a spectacular term, mission creep.
Well, I'm boomeranging it back from the administration, put it that way.
No, I think you're bringing out a great issue, because the Fed's has this dual mandate that it has defined or interpreted, but the mandate was given by Congress, but its policies actually have gone beyond that, and there is mission creep, and one of the contentious issues that may arise, and there's already debate on it outside the Fed, is, to your point about Silicon Valley Bank in 2023, should the Fed be supervising banks? A lot of analysts would say no. And Marin has a proposal on the table which would take that power away from the Fed. So there's a lot on the table here.
Yeah, sorry, go ahead.
No, please.
In that regard, so some of the proposals that Steve Marin and others in the administration was talking about would be rather constructive. It's a matter of throwing the baby out with the bathwater, changing the processes, taking some of the stuff off the table. It might be positive, but of course then there's the politicization of where rates go. So a double-barreled final question on this topic is, first, who are a couple of names who would concern you the least if they were appointed You mentioned, I think, earlier on James Bullard. There's
Okay, so of those who I think would be, let's not talk about it as a double negative, but as a positive.
yes, okay.
I think Chris Waller
Mhm.
would be a very, very good chair of the Fed. Before he became a governor, he was director of research at the St. Louis Fed. And so he has attended every FOMC meeting, since before the financial crisis. Everybody knows him. He's a very smart economist who thinks clearly, and the Fed understands him and would not be intimidated by him. He would play an inside role and would think very carefully about any types of reforms, in addition to thinking very carefully about monetary policy. I would put Jim Bullard in the same category. Very, very thoughtful. And what I really like about Jim is his approach to monetary policy, even though I've disagreed with him occasionally in the past. He's very systematic in his approach, and that would be a plus. I like Kevin Warsh. Financial markets don't like change, so we're going to have some change here, and let's hope
We're going to have some change, but also I think one of the points is the administration trying to create a way of inflating out of their debt by creating abandoning 2% inflation essentially for the kind of nominal economy that alleviates some of its problems in this deficit, which despite the tariff revenue and there's nothing being done on entitlements, etc., that maybe the Fed's priorities will change, and that fits into the term premium and the long-term inflation expectations.
But John, here's where I don't think the Fed's thinking. I don't think the Trump administration's thinking that way. I don't think they're thinking in terms of inflating their way out of debt. I think they're somewhat naively thinking about growing their way out of the debt with real growth. And there's a huge difference. And of course, one of the differences, and we barely touched the surface on this, if you grow your way out of the debt with very strong sustained growth, then profits go up, expected rates of return on dollar denominated assets go up, so the dollar goes up, and tax receipts go up, and everybody, including the government, have more resources to allocate to things they want. Inflating your way out of the debt has the opposite problem. Inflation goes up, which undercuts household and business purchasing power. The dollar goes down, the gold goes up. So they're really opposite. And I think the Trump administration is banking on stronger growth and is far too starry-eyed about it, as reflected in Marin wanting sharply lower policy interest rates to achieve his economic growth and inflation. So I think they have a model of the world that's supply side driven, that I think at this point it's a little delusional, because it is ignoring the negative impacts of the tariffs and the immigration clampdown on real growth.
They're not internally consistent, basically. And I think that because of the headwinds from tariffs and immigration, monetary policy is having to probably do more of the work, and that's part of the inflation of asset prices story. One could argue that.
Yeah, and to that regard, what will happen out there in time is if this persists and rates go lower and lower, and the economy doesn't respond, and you could have a steeper yield curve and a lower dollar, and problems. So they have a different vision of the world.
Right. So just finishing up on the long end of the market, we've talked around that issue a lot, but we have it. When I was working at CalPERS, we had people who'd been there 30 or 40 years and they'd written down the yield in bonds, and we had Bill Gross at PIMCO was showing us a smiley cup where eventually bond yields will go back up the other side. He didn't live to see it, or he didn't stay in his position long enough to see it. But we have reversed some of the longer term rally in bonds. We're at, as you say, we're at 4%. We have a relatively flat, slightly steep yield curve. What does all this stuff mean, do you think, for the yield, for long-term borrowing rates for the kind of clients that are in Rex's firm and elsewhere, in the residential and non-residential construction side? Are we going to revert to a kind of a new normal situation with this low population growth, and then that kind of puts a cap on interest rates, or are the various factors that are going to take place lead to a continuation? It's a very hard question to answer. It's a balance of risk thing, but I wondered if you had any perspective on that.
Let me add this perspective. It depends to some degree on the dollar, because John, as you know, over 30% of all U.S. publicly held debt, that is gross debt minus the debt held by the various U.S. trust funds, over 30% is held by foreigners. We had a sharp run up in the dollar after Trump got elected, and then beginning in January, where he started talking big time about these very large tariffs, the dollar fell. And since then, luckily in the last 3-4 months, it's been pretty stable. So this is the risk I put out there. If the dollar were to fall, and as you know, having spent a career on trying to get involved in FX markets, if the dollar were to fall further on a sustained basis, not just one day, but on a sustained basis, then foreign portfolio managers, they're not going to sell dollars. They're not going to sell their dollar positions, but they just won't reinvest them, and they'll let them roll down a bit. And this could spell trouble, because the increase in the government bonds, as a consequence of deficit, have to be absorbed by somebody. And the issue is at what price? And it could lead to a lousy quarterly auction. It could lead to higher interest rates. If the dollar, I'll repeat something that I said, I guess in late spring, and when the 10-year bonds were about 4.5, I said, if the dollar stabilizes in here, then there's room for bond yields to fall. And they've fallen. So now you're at like 4.1. They've backed up a touch since yesterday's Fed decision. If the dollar stabilizes in here, I think there's less room for bond yields to fall. I'd say the risk is they increase a bit, but not that much. Not that much. So I've got my eye on the dollar as one of the key ingredients as to what happens to bond yields.
We do know that these foreign counterparties, rather than outright selling, so far they've been hedging, right, their dollar exposure, but there's a limit to how much you can do that.
I think that's right. And they may just say, hey, listen, if I expect the dollar to go down another 5%, I might just, let my position unwind a bit. And, that is definitely a concern. So meanwhile, I do expect the Fed to ease further. As I've argued for years now, based on history, the Fed has always responded more quickly to labor market weakness than it responds to higher inflation. And once again, we're seeing this in real time, them following that asymmetry. And I do expect that even as inflation stays above 2%, let's say it hovers around 2.5%, I do expect the Fed will cut rates a little bit more, which should involve some steepening of the yield curve.
Yeah, and meanwhile, I think again, correct me if I'm wrong, but Jay Powell yesterday said that a year out from now, the steady state employment growth may only be 0 to 50,000 because of these issues of immigration, etc. So the issue becomes as well, which number would you be looking at, payroll employment or the unemployment rate? Because you're not getting the labor supply side growing very much at all. Which
I would be looking more at employment, but also aggregate hours worked.
Mm-hmm.
But also based on on the wealth effect, I'd be looking at the consumption numbers and also checking to see if business investment, particularly in intellectual property, software, and R&D hold up. So you got to take an overall view of things. But I do think the Fed is tilting toward lowering rates. It has this mindset where it still perceives monetary policies mildly restrictive, and we will see.
Yeah, it definitely is more of an art than a science when you look at things like maximum employment or flexible inflation targeting and restrictive versus otherwise. There's an element of art here, and probably all 19 members of the Federal Open Market Committee have a different concept of that.
They do. They have different models, and the one thing the Fed is not is it is not systematic in its conduct of monetary policy. It covets its discretion, and it pushes back on relying on anything like the Taylor rule, even as an input to its decisions. So it'll remain kind of winging it in that regard. And keep in mind, when an important piece of data comes out, the Fed, they don't have any better instincts on how to interpret it than anybody else.
And they realize also that the data is subject initially to very poor response rates and stuff like that. So
that's
the best. It's the best we can do. And so an interesting takeaway, and I would like to keep talking for hours, but interesting takeaway is that probably the Fed will continue to ease, maybe 25 basis points a meeting for one or two, and then more data driven as we go into next year. And then we do have these 6 or 7 folks who have no further cuts in their dots, including a few of the voters. Do we get back to a stage where at some point we have a two-way descent, like I think we last had that in September of 2019? Eventually we start getting a little bit more dissent, or do you think Jay Powell can hold the thing together and get a buy-in to the idea of gradually feeling our way toward a kind of a neutral rate for the current economic conditions?
I think that depends on to what extent does the economy hold up. But you mentioned this, Powell by his very nature is corporate and a consensus builder, and he discourages dissents and works hard before every FOMC meeting to talk to virtually every Fed member to avoid dissents. And so I think a lot depends on how the data are. But when you talk about how the Fed interprets the data, it's employment that matters. There in that regard, employment is part of their mandate, even though nobody knows how to define maximum. GDP is not part of their mandate, and so the employment holds the key, and we'll just have to see what happens. But once again, the Fed, while I'm a constructive critic of the Fed, I support the institution, and they are in a very, very difficult situation. And the question is, should they respond to the negative impacts of misguided economic policies. And it's a complicated question, John, because they know that monetary policy, moving interest rates up and down, is an aggregate demand tool that cannot offset the positive or the negative implications of, tariff policies and immigration policies and other policies that directly affect the economy.
Right. Well, on that note, Mickey, again, it would have been great to speak for another hour, but and your perspectives are so valuable, and hopefully this has been enjoyable for you as well. Just a shout out on the call to anyone who may watch the future tape of this is that Mickey's research. He has his website, which is mickeydlevy.com. and is always being published in the Wall Street Journal and on podcasts with people like Kathleen Hayes, who does a much better job than I do as an interviewer, and also his work on the Shadow Federal Open Market Committee and at the Hoover Institute as well. He is a very valuable resource, so I would encourage people to check into Mickey's research and potentially in the future take advantage of it. So thank you very much, Mickey.
Thank you for having me.